Welcome to Financial J Fitness J.
Skibidi bop, boop, bop, dip, blah, boop.
Welcome to Financial Fitness J. I'm Julio Dawkins.
And I'm Jade Harrison.
And today we're going to continue with our part 2 of terms and definitions, basic terms and definitions for the stock market. Jade, IPO. I know people hear that term all the time and they can't really demystify what it is saying. See if you can break that down for us now. So let's see what we can
IPO.
learn.
It's an acronym, Initial Public Offering, which is when a private company becomes, the process by which a private company becomes publicly listed. They have new things now, which are called SPACs, Special Purpose, something on a vehicle that Wall Street is using to circumvent the entire IPO process.
Okay.
Yeah, that's a new thing, but we'll focus on IPO. Let's start it off. So an IPO is basically a private company going public, seeking funding from public markets. Yeah.
So give us just continue a little bit more. How does a company go about trying to do an IPO on a stock market? What do you think then?
Well, that's a technical thing I don't know if you guys necessarily need to understand in its fullness. But exchange guides a company in terms of IPO. There are basically strict guidelines and strict requirements that a company needs to meet in terms of financial transparency, governance, structure, some kind of profitability over a certain period of time. These are like the guideposts when you go into an IPO.
I think the reason why I'm saying this to our viewers is that when they want to buy shares in an IPO, right, they need to understand that the company has to go through all of these levels of scrutiny.
Yeah, which is the purpose of the exchange. So the exchange is like the regulators of IPOs and stock trading. And in essence, they're the initial regulator because you have to meet the guideposts to get to do an initial public offering.
Awesome.
And then you have the actual regulators after that keep track of you after you have been listed on the exchange.
All right, awesome. All right, so what is a public float?
A public float is the number of shares that are actually available to the public. So when a company does an IPO, they don't actually have to list all their shares. What they can do is they say, we're going to list 20% of our shares at the company. So that's what's publicly available. So that's their public float. So, for example, a lot of the companies in Jamaica, you're entering into the IPO sometimes and you're saying, yes, we own a company, but only actually 10% of the company is available, and some of that ownership doesn't even have voting rights sometimes. Or the fact that they are so minuscule in volume, they don't have any real organizational power.
So some of those shares are class too. So you have preferred shares.
That as well. You have many aspects of that. We could spend a whole video on that.
Guys, look about shares and what is preferred shares and what is ordinary shares. And
we can find in the next video. We can continue the series, guys.
Yeah, we can do that. Alright.
I have also, which is why we need to look at authorized shares. Authorized shares is what I was making reference to earlier.
Right.
All the actual shares available for trading or for selling so that might be shares that the directors hold, shares that the company still holds that is available should they want to do some other thing. Like for example, recently Tesla offered a specific amount of shares to a specific party, not public listing. So they still had additional shares apart from the public float that they could offer to a private party to raise additional funds, which they did. I think it was like a couple $1 billion.
Wow,
so
crazy.
They're very liquid. I think they're around 9 to 15 million, I'm not sure, in liquidity. No.
What is secondary offering? And how does that help us to increase our wealth?
Secondary offering is, as it implies, you have done an initial public offering and you want to raise more funds, your company is doing well, you see opportunities you want to take advantage of as an institution, so you do a secondary offering where you offer more of your shares to the market. And if people see that you're doing well, I think persons will try and take up that additional shares. So it may be the same persons who bought the initial offering, or new persons who get an opportunity to invest in the IPO. And then you can make additional funds as an institution through a secondary offering.
So Jay, you're telling me that I can average down if I bought an initial share and bought a secondary share at a different price?
Well, they can average down their cost of funds because it may be a cheaper way of getting funds for the
Guys,
company.
I'm learning.
As an institution, that is.
All right. blue chip stocks.
We have discussed this in our producer will link the videos. Blue chip stocks are like industry leading stocks. They have a long track record, they have been listed on the market for some time, they have performed profitably for some time, they are like industry leaders, sector leaders. These are companies that are stalwarts, these are like companies that have reached a status of like a utility. To the point where almost feel like these companies won't crash in the next 10, 15 years. That's because they have developed the record. So they would have a lot of necessary. Some of them have growth capacity, but not as much as a new company that has that.
Okay.
That side. They're not at that point in the cycle of growth.
The people have talked a lot about foreign exchange and the forex market. Could you demystify what that is to us?
All markets are markets. Let me explain what I mean by that. Buying and selling of some good service entity instrument is a market. The forex market, or they like to call it forex market, is actually the foreign exchange market. So it's actually foreign currencies being bought and sold as a market, but it's a global market. So I think it's actually, it's actually the largest market, and it is the most highly liquid. Sometimes it can be the most volatile. I think it might be, because everything affects currencies. Like you're trading economies, you're trading countries, you're trading news, you're trading people's sentiment. So it's a very big, diverse market. But it's essentially buying and selling of currencies, and people use different strategies and different approaches. But all in all, it's just buying and selling money. Buying and selling US, buying and selling euro, buying and selling CAD, Canadian dollar, or any other exotic currency you can think about. So it's really just buying and selling of money looked at as an instrument or as another good to purchase and buy and sell.
Okay. Hedge funds and mutual funds.
These are two different types of investments you can get into.
Would you say investment instruments?
I would say a hedge fund is an instrument. A fund is basically a pool of funds. So what you can do is you can put your money, your personal money, or your company's money, or your retirement fund, can invest in the next fund. So but a hedge fund is more of a high risk. So normally persons need to have a certain net worth before they can invest in a hedge fund. Because you need to be able to lose money because they're going to take risks. So as a means of regulation and managing the entire world and people's greed and sentiment, there are certain requirements to invest in a hedge fund as opposed to a mutual fund. A mutual fund is very typical. There are many mutual funds with varying approaches. Like you have Vanguard, VOO, VTI, you have some index tracking funds. You have many of them. So
you have hedge fund at one end and mutual fund at the other. So it's
you could say that, but there are many different kinds of funds. So it's not as simple as that. It's just like a peg on a petal on a leaf on a flower with many leaves. It's just variations of the same thing, but with different risk tolerances, different sector approach. Yes, it's very customizable. People always want to make money, so they create many different. Like you have ARC investors, like 4 or 5 different funds they can buy into, like innovation funds. So like you can invest in innovation. You have market tracking funds. You have blue chip tracking funds, and then you have hedge funds, which some of them go into a lot of alternative investments, or they invest in the third world countries where the risk is greater, but based on your calculation, it is worth it. And so there are different kinds of funds. You have to just look for a fund that suits you. As a new investor, you look at exchange traded funds, which is a form of that, and you just invest in that where they manage the risk and you're buying into a collection of stocks. And that's the benefit of the funds. It's a managed collection of or pool of investments that you can buy into. Yeah. Now look at brokers. What are brokers? A person who buys or sells a security on your behalf on an exchange for some kind of set fee. So for example, you have your money at an institution, they will assign you a broker, and you're able to call that person and say, on behalf of me, do this. Or initially at the outset when they open your brokerage account, they will say, what type of customer are you? Do you believe that you'll be doing 10 trades for the year? 100 trades for the year,
Right.
or what is the general investing approach? And then based on that, your broker will determine how much you need to be a middleman in what you are doing. And there's all associated costs with help and assistance. So you might have to deal with those kinds of associated costs. But a broker basically is a person, you give instructions to buy or sell.
And they give recommendations, you know?
Some of them give recommendations and some of them give just general market reports, and then you determine what you want to do. But some of them do have papers that they produce and you can read, or it's put on the website nowadays because everything is electronic, which is brokers are even electronic nowadays, and there are platforms now, so it's even more different things, different approaches in terms of just strictly like semi-autonomous stuff.
Day trading.
Day trading. Day trading is you're buying and selling things intraday. So it's more of a person who, by the end of the day, whatever they bought, they would have sold. Whatever they have shorted, they would have closed it out at the end of the day. So that's the rule for a day trader. So basically, that's a person who they do transactions, and by the end of the day, they won't carry anything for the next day or the next week. Whatever profit they have made or loss they have made, they will next at the end of the day, they will close up their account at the end of the day and say, okay, I made a loss today or I made a gain today. And that's a specific approach that some people take, and some people don't believe in it at all. So day traders do that.
What is a dividend?
A dividend is where a company makes some kind of profit over there, and they have stipulated that they will give a certain amount of cash flow, free cash flow, back to their investors to show that this is the profit and this is your share of it. We're not going to reinvest in the business. We have some funds set aside to reinvest, or some funds set aside to provide cash flow for our investors. So it's basically a portion of the profit that is allotted to the investors, whether it be quarterly or annually or semi-annually, depending on the structure that the company chooses to. But what is typical is that once they decide to give a dividend, they will continue giving a dividend, because it may signal negatively if they don't continuously provide. It's not normally taken as an indicator of the company's health.
The next term I want to speak about is exchange. I'm not fully clear on the exchange thing. Is Nasdaq exchange the same thing as a Jamaican stock market, or is it that Nasdaq and the New York exchange is a part of the US stock market? How does that work? What is the difference there?
An exchange is basically a marketplace. So instead of saying a marketplace, they call it an exchange. So basically, you have the New York Mercantile Exchange, you have New York Stock Exchange, so basically different things are traded on different exchanges. So you have like goods and so like gold, and you have orange futures, things that are traded on the Mercantile Exchange, and the Stock Exchange is self-explanatory. It's an exchange for stocks. So the stocks are traded on that. So like most of the companies in the US, and for Jamaica Stock Exchange, the local stocks are traded on that exchange. So basically a marketplace where you can get information. It provides some sense of validity. It will provide at the IPO level the guideposts and some kind of sense of.
So an exchange, as I said, is more than one exchanges in US, and the stock market is just one of those markets.
Because essentially exchange is marketplace. Let's look at it that way.
Jamaica isn't as mature in its level to have different exchanges, only the stock market really.
You could say that. That's actually right. We're not as liquid, or we're not as diverse. And the fact is that global markets are way bigger than local markets, so there's way more to do. And even so, there aren't that many exchanges. You normally have one exchange or one stock exchange for a country, per country. So I think we have our fair share, but as a part of the global economy, we can tap into other exchanges nowadays, especially with technology.